The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Department of Defense is working with Google to help secure America's digital defense systems, from establishing cloud-based zero-trust solutions to deploying the latest AI technology. This is a new era of American innovation. Find out more at g.co/American innovation.
Reality radio for a really great future. We're talking real money.
You work hard for the money. So hard for it, honey. You work hard for the money, and we hope you have a 401k. Okay? We do. We hope you have a 401k because, it's good for you. However, there's something you probably should have before the 401k, and we'll tell you what that is in a minute. Hello, everyone. I'm Don McDonald in the Florida Talking Real Money studio. Tom Cock is in one of the two Washington studios. The other looks a lot like a laundry room. This is not the laundry room.
This is the luxurious studio in the offices of Appella Wealth. Beautiful studio.
Oh,
Love this.
Yeah. Nothing like it. Got a window looking out over.
A window.
Oh, look, it's another gray day in Seattle.
Oh, yeah, and there's a guy out there blowing leaves. There's a lot of leaves that have fallen, as you know, in the last 3 months here. So, kidding. Yeah.
Oh, yeah, those are evergreens out there. I was going to go, why is it green?
Well, and even the other ones pretty much stopped falling in like November. We are in March now, so.
Well, there's dust.
Okay. Not really, because it would be mud with all the rain.
That's true,
so
mud. Anyway, welcome to our little get-together. We want to talk about your retirement funds. Now, these, we believe, are one of the most crucial parts of your saving and investing plan for the future, because the biggest need you will have for money down the road, it's not the house, it's not the kids' college, it's not the car, it's the retirement. A retirement, generally speaking, requires to live reasonably comfortably, not well, just comfortably, about $1 million saved. So you need to start soon, and you need to start smart. And one of the ways you do that is by investing in your 401k plan at work. However, a very large percentage of you mess around with that money in the 401k and the like that should be sacrosanct.
Yeah, and the problem now is with fairly recent rules changes, which, as you remember, I opposed, that allow hardship withdrawals. Yeah, I like going back.
I was against them. Yeah, nobody paid attention to me.
They let you take money out for things like medical expenses, prevention of foreclosure, tuition payments, funeral expenses. Now, if it's for my funeral, you go ahead and take it out of your retirement plan. I got that.
You're not going to care.
Costs related to a purchase and repair of primary residence. You get the point. There's a bunch of conditions the IRS will let you take out for hardship, but you still pay the penalty and you still pay the tax. So
are you sure you pay the penalty?
Yep.
Because I know I thought you got away.
People who take hardship withdrawals from traditional 401k accounts must pay income tax plus often a 10% penalty if they're younger than 59 and a half.
Some things are allowed.
Yeah, maybe.
Yeah.
The point is now the number of people doing these rainy day sort of grabs of their money, 5%. 5% of account holders. That is a new record, up from 3.6% in 2023. You see, the trend line is not your friend here. This is the wrong direction. And the blame, they say, is that now when people go to work, the default at your employer is you're in the plan.
Yeah,
you don't have to sign up.
Wait, you've been saying for years that's a good thing.
I think it's a great thing.
Well, what if I need money in an emergency?
Well, this gets back to where you started the program. The first thing you probably should do before you enroll in the retirement plan is set up that emergency fund.
But what if I'm already I'm automatically enrolled in the 401k plan?
Then you could put in a very, 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 very small amount in the 401k plan.
Yeah, here's kind of the rule of thumb. I think this is a reasonable way of looking at it. It's a good thing that you're being opted in automatically. We think that's good, although this comes back to the fact that we don't want to plan for the future when we're young because we think we've got forever, and it feels like it then, but then wait till you're our age and you're going, wait, I'm out of time. You need to participate in the 401k, but you need to actually look at it every once in a while. If you don't have emergency money set aside, you need to make sure you're not contributing any more than the amount that will get you the match initially in your 401k.
I think that's
you
good advice.
You want the free money.
Yeah.
Over and above that, though, if you can't afford every paycheck to put some money into an emergency fund, then you need to reduce the amount you're putting into your retirement plan for a while until you get to that 6 months or so of expenses so that you're less likely to touch that 401k. Because the problem is when you take money out of that 401k and you pay that the tax and the penalty, that's money you're likely not going to make back. You're basically starting from behind scratch.
Yeah, I'll give you a couple of numbers here in a minute. It's a fascinating thing. Vanguard administers, of course, many 401k plans. They say 61% now automatically enroll new hires. That's up from 36% a decade ago. So that means, yes, more people. Yeah. That is a good thing. But if you're in the spot, okay, all right, I get it. You don't see it coming. Something happens to your house, or there's another reason you got to have the money, and or you have a financial emergency that's a real emergency, like foreclosure. What do you do? Well, okay, there's a couple of things to consider, I think, before you get to the point of pulling the money out. How about a loan from your 401k?
Are those the norm, though? I think they've been falling by the wayside.
Well, because people have said it coming out too easily. Now,
I did look. No, I'm asking.
I looked at a piece that showed the immediate impact of taking $15,000 from a $38,000 account balance. Now, if it's a loan, you get to 15, right? You still got $23,000 left in the 401k. Okay. If you do the withdrawal to get the 15, you got to pay taxes on it as well, right?
Right.
And there's only $18,000 left in the 401k. Money that you got to pay the taxes and penalties of somewhere around $5,000. Money that as you correctly point out, Don, you're probably not going to make up. Now, if you borrow the money, you got to pay it back in time and on full. You got to pay the interest, and it is truly a loan to yourself. And if you lose that job, then you got to pay it off, right? The money's all got to go back in there. So there's some disadvantages, but I think way before taking the money out, which my worry is it feels too easy. This is just another way for people to get their hands on cash. Like, oh, I didn't really want to be in that plan. Now I can go get the money out, rather than being thoughtful. This should really be way, way, way at the end. Don't you agree, of any decision about withdrawing money?
Yeah, absolutely. By the way, I went and checked with the IRS. The exceptions to the 10% tax penalty are as follows. These are emergency distributions where you don't have to pay the distribution penalty. One of those is the birth or adoption of a child up to $5,000 per year.
I'm out of that one.
Remember, you're still paying the taxes.
Yep.
Total or permanent disability. Up to $22,000 if there is a federally declared disaster where you live.
Wow.
$10,000 for the costs of domestic abuse. I didn't know. For qualified higher education expenses, you can take it out without the penalty. Pardon me?
That's it. No, I'm just saying, keep going, because I've got a couple other ideas here.
Qualified first-time home buyers up to $10,000.
So they pay the tax, but they don't pay the penalty.
They don't pay the 10% penalty.
Yeah, okay. So the money comes out.
Medical, health insurance premiums are unreimbursed medical expenses. If you have a terminal illness, and if you're unemployed, you need to pay for health insurance. So there you go.
Those are all very reasonable things. But how about, for example, taking it, and I hate to say this, but in some cases it makes sense, from your Roth IRA, which could be outside of an employer plan.
Roth IRA is the 5-year rule.
Yeah, you got to look back.
Right.
So could be an issue too.
But again, this all goes back to adulting. And a lot of people, even as old adults, don't adult very well. You need to work on adulting.
This is not that kind of program. But
yes,
okay.
it is. This is one of those adulting things you need to do is build an emergency fund.
Isn't that Dr. Phil's show where he tells you to be all grown up or something?
Yeah, it is.
Okay. All right. But now, but let's just finish very quickly.
Right. I just don't want you touching your 401k.
I know. Other places. So if it's medical, couldn't you go to your HSA?
Well, yeah, you had to fund it.
Well, okay, you're right. Money had to be in there, but that would be a better place to draw for a medical issue.
It would be a whole lot better.
But I think people just the 401k, it's easy. It's a piggy bank. I can go get it. I can get it the money. But I like where you started.
Very last piggy bank. Though.
Thank you. It should be at the end, but I like what you said, and that is the best advice for somebody starting, and we talk to a lot of parents who have a kid that's 23, first job, would be if you're automatically enrolled in the 401k, then okay, do 1%. But make sure you build up that emergency savings first, which is really hard to do. The automatic 401k for most people, that comes out, you don't see it. The emergency savings, you're going to have to transfer the money from your checking account to some of the sort of savings plan, set it aside and let it grow and have it there.
Sitting there staring at you.
I know. Every day.
It's like, don't touch it.
Yep. So for me, borrowing from the 401k instead of taking it out, I still think has most advantage. Always having an emergency fund. And then if it's the last final hindmost option, then go ahead and pull that money out of the 401k.
Okay, actually, I'm going to throw another one. I'm going to throw another one in the middle.
Oh, please. Thank you.
I am. I'm going to actually throw two more in the middle. If you're not exempt from the 10% penalty, I would almost rather see you use a credit card and pay it off as quickly as possible than take it out of the 401k. And
borrow from somewhere else.
Yeah, borrow from somewhere else, whether it's a credit card or a HELOC or a family member.
Somewhere
write up a document, borrow from someplace else.
That 401k, hopefully, is just out of sight and out of mind. It's properly invested, and that's something you look at when you're 50 years old.
Donate plasma.
Oh, what do you get for that these days? They probably wouldn't take mine because they say the blood's too old.
They don't want you. Yeah.
I'm not going to give that to somebody else. Come on, man.
Your blood's dried out. It's like dust.
Not going to touch it.
That's why the guys out there with the blower just blow your
trying to
blood
reactivate.
Away.
I think that's really good advice. Borrow from any other place other than your 401k. Right? Yeah. If you have to do that.
401ks are so important to
They
leave
are
alone.
So important. And what we realize is what you said. Most people wake up at 50 and say, wasn't I supposed to do something about retirement? If you turn that around and you started at 20 and you save till 50, you don't have to think about it after 50 because you've had all those years of compound growth.
And by the way, when we say 401k, we mean 403b,
Thank
457,
you.
simple IRA, SEP IRA.
Exactly, yeah.
SAR,
all those
SEP.
places. Yeah.
Yeah.
Yeah, I just talked to a group of self-employed folks, and I've forgotten the advantages for the self-employed that the SEP IRA has. The amount of money you can put in is astounding. Here's the downside. You got to put it in. It's hard because...
Oh, yeah, that little detail.
The 401k is so easy because it comes out of your paycheck every 2 weeks and goes in. When you're self-employed, oftentimes you have to decide, well, let's see, I got to pay this, and this. Oh, there's only $4 left. You got to pay yourself first. Really hard concept when you're in business. You and I have been through this small business.
Can you imagine? I mean, think about this. We've done it as small business people, and it's really hard. Can you imagine as an employed person if every 2 weeks you had to write a check to the Internal Revenue Service for your taxes and to the state?
Yeah,
if
not
you live
easy.
in a tax state.
Yep.
If you had to do that every 2 weeks instead of just having it come out of your paycheck, do you know how many people would not pay their taxes?
Yeah. Well, and would it matter because there's so few people working at the IRS anymore? Yeah,
right.
so no one would notice. So,
we
so
will
please,
be Italy. I'm so afraid of that.
Please don't do that. So please, as I said, last
words. Tom's done.
This is it. Can they take the money out of the 401k to pay for my funeral?
Words.
Okay.
And by the way, death is one of the reasons you can take it out.
You could take it with you.
Right here, after death of the participant, you can take it out without a penalty.
All right. Let's see if a couple questions can rescue us from this. From Woodstock, Georgia. And by the way, thank you I just watched that film on that concert you had in the late 60s. Fantastic. What a great time that looked like it was.
Somehow I really, truly don't believe that Woodstock would have ever happened in Georgia.
Oh, dang, that's Woodstock.
Not in that time period particularly.
Yeah. All right, I was too young for all that. So Jay writes us, all joking aside, Jay, thanks. First, love the show and listen faithfully. Thank you for that. I just listened to Stocks Also Fall and heard the common theme about how difficult it is to find a fee-only fiduciary. Yep. I've often wondered why you don't discuss referring to one of the professional organizations like NAPFA. I found my fiduciary through NAPFA and have been very happy with him.
We do.
Well, let me finish. I would speculate that referencing such an organization would not be ideal for Appella Wealth, and I completely understand that perspective. I also think many people struggle and get lured by a sales pitch that they think is independent financial advice. I'll take the last part. Yeah, they do. Or they just met with somebody yesterday, said, well, I've always worked with this guy, Ed Jones, because he's been my pal, et cetera, et cetera. Yeah, they're your pals. I get it. It's called affinity. And that's not always the best business decision. But referring back to our association with Appella Wealth, yeah, we'd like you to be a client here, but we've recommended other firms. We've recommended NAPFA. We've recommended other organizations many, many times on the program as a way to go find a fee-only 100% fiduciary. Correct, Don?
Yeah, absolutely. Maybe we haven't suggested it as much as we should.
I think we say there's others that do the same thing we do and do it well.
Yeah, there are lots and lots of them. One of the problems is with any service, with just doing it on your own, it really doesn't matter. The fact that they are registered doesn't, well, it does make them, with NAPFA, it does make them fee-onlys. That is a good thing. But you still have to do homework. Please do your homework. Make sure you look them up. Make sure you read about, because there are there can be high fees. They can have some really lousy strategies. But yeah, we suggest them, maybe not as much as we should, because we want you to go out and do it yourself.
Yeah, but I think going to NAPFA, you're going to find a good professional. Sure, it's not a guarantee, but I think you will.
I think you, if you still do research.
Yeah. No, absolutely, 100%. But we recommended those organizations. All right, from Joe in Palm Coast, Florida, says, I very much enjoy the podcast. Listens daily. I know that what I'm going to relay does not fit the mold that you generally discuss and love your opinion. We're both 71, guaranteed income from Social Security pension and immediate annuities to cover all monthly expenses, plus a small amount additional. 6 months income in a high-yield savings. Congratulations. We're not concerned about leaving money behind, but when we go, we want to enjoy life while our health is good. Don't know that makes sense. Anyway, he wants to enjoy his life and not worry about it. I love that. Heavily invested in a variety of income-producing preferred stocks, ETFs, and corporate bonds with no more than 5% of the portfolio in any one investment. Our top 5 investments. Are you ready, Don?
Yes.
Yes.
I'm ready. Okay.
SPYI.
SPYIs.
Yes.
Okay,
I did take the time to look these up, by the way. So go ahead.
That's an S&P something.
Yep.
Okay, I have to get into my Morningstar. I was
SPYI.
SPYI is... I have no idea. That didn't come up right. I messed up. Sorry. I'm ruining the whole show. I always do. NEOS. S&P 500 high income ETF.
High income.
What in the heck is this thing?
Yeah, well, there's more.
Oh, hold on. Let's just do them here one at a time.
Yes, I think you're going to enjoy it.
Oh my goodness! It only has 500 stocks in it. How do they decide what to have in the? It's all stocks.
Yep.
High income.
Yep.
Its number one holding is Apple. They don't pay a high dividend. Well, this is a very strange
All right, set
fund.
that one aside. How about FLRT?
Flirt? Is it a dating app? Pacer Pacific Asset Floating Rate High Income ETF?
Floating rate securities. Gotta love those.
Lord.
Yeah.
And look at the expenses on these things. They're all running over 60 basis points or 0.6%, which for an ETF is very expensive.
Well, if you liked flirting, you're going to really like JA.
Non-rated bonds. Look at all these.
JAAA.
JAAA. Janice Henderson. Collateralized loan obligation.
These
ETF.
ring a bell? They ring a lot of stuff for me.
It's cheaper, but look at that yield. Well, that yield and the fact that it's collateralized loan obligations. Anybody remember CDOs or CMOs in the past? And by the way, 40% of that portfolio is non-rated paper.
Oh, how about JEPI? I
love that movie, Return of the JEPI.
Well, yeah, and they may or not return your capital with the JEPI involved.
JP Morgan.
No, JEPI. JEPI. Yeah.
JP Morgan Equity Premium Income Fund.
Yeah, correct.
That sounds like I'm guessing, right off the bat, that is a covered call writing fund.
Something weird.
That's my guess. 35 basis points. That is a covered call writing fund. How did I know? That?
And then...
there's
it's
another
all
one
in the HIPS, HIPS.
Granite Shares High Income ETF. Oh my gosh!
Okay,
folks.
Before Don finished, I'm just going to say, Joe, you were doing really well at the beginning of all this, and then you told us because he said they have guaranteed income, blah, blah, blah. And then we got into the portfolio because his question is, with this information provided, do you see any real value in our contracting with a financial advisor, fiduciary?
Not this one.
Well, no, but he means with these investments, should someone be looking them over? Yeah, pretty much.
Yeah, selling all of them.
Well, yeah, these are a bit of a concern. These are,
for example,
he went into a low standard deviation, which I don't trust.
Well, okay, first, that last one, the HIPS.
Yes, HIPS.
The HIPS, the vast majority of the bonds in that portfolio are non-rated.
Explain what that means.
It means they're garbage. Non-rated or triple B or B or below B.
I think there's an expression for them. They can't even call them junk because they don't even rate that, correct?
They're junk. They're junk. Look at this yield, 10.49%. With an expense ratio of 1.6.
Well, they got to get their part of the huge amount. So, no, Joe, you should have somebody look over this portfolio. And I'd be questioning why, if you're not leaving money to others, if you have your guaranteed income basically through those other sources, why are you taking all this risk with these wacky funds that could really get into trouble in the next downturn, which may or may not have recently started with the upheaval in the stock market?
And I don't know where he's getting the standard deviation's low. I'm looking at the 10-year standard deviation on the Granite Shares on HIPS. It's 19.
Yeah, he says it's overall 6.21.
Oh, wait a minute.
I don't know how he gets that. I don't know where that comes in, but
I'm going to go to the JP Morgan one now. Hold on. Let me go back to that just out of curiosity.
JEPI?
Yeah, that one is not very old, but its 3-year standard deviation is 11. Wow. I'm not even talking about volatility. I'm talking about just credit quality.
Yeah.
Credit quality is not related to volatility. Credit quality is, oops, if we get into a bad time, could you lose a lot of money? And with every one of these funds, my answer is, yeah, you could.
Yeah, and exactly. But
they're equity risky.
Why? Yeah, why would you do it? Now, an occasional flirtation, FLRT, that can be kind of pleasant, but I don't recommend it in your portfolio. Let's put it that way.
At our age, even that isn't.
Leaving that aside for a moment. So all right.
60. Hold on.
Yeah.
Hold on. I want to check the standard deviation on Flirt. Okay, Flirt is low. Flirt 10-year is 4.5.
Okay.
Because Flirt is all bonds. So it's going to have low volatility. Yep. But Flirt's portfolio is, hold on, I got to get my number here. Junk is
floating rate securities.
95% of the portfolio is junk.
And what's the standard deviation on SPYI, which has
I spy with my little eye,
and I'm going to find out how high it can fly.
You just wanted to play a little poetic game, didn't you? 68 basis points. Jeez Louise.
These are expensive funds. They're risky funds.
Okay.
And
That one is too new. Too new. But let me look at the performance. When did it come out? It came out in 2022, so we don't have a full 3 years yet to measure standard deviation. But it looks like it has a pretty high degree of volatility, given that its 1 year return is 8, its year-to-date return though is negative 3.7. So its negative 3 month is negative 6.16. So it's playing like the market.
Yeah.
It's bouncing around.
Like
so it's going to have it's going to end up having,
15,
for me, it looks
16.
like probably about an 18 to 20 standard deviation. So,
Joe, these are not funds that we would use nor recommend. And should you have a professional review them? Yes.
Please do. Yeah,
I think that's good. So,
okay.
All right.
We did really well.
Thank you. I'm so happy.
Can we go now?
Yeah, I think we can.
Do you want to plug anything? Nope. You got nothing to plug?
Nope. Nothing to plug.
All right.
Enjoy your life, and thank you for listening. How about that?
Go to talkingrealmoney.com. Send us questions on the Contact Us form. And, if you want help from an advisor, we'll provide one for you at no cost. It sounds like a Miranda warning.
It does, yeah. We will be provided, as you know.
Yeah. An advisor will be provided at no cost to you should you want one. Otherwise, you're guilty. Go to jail. Bye. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.